Hello and welcome back to the course on economic impact of climate change. This is episode 8, and in this episode we are going to talk about how climate change will impact the service sector. Let us get started. So this is the structure that we have been following, and I hope you have watched the earlier videos in this series. In the earlier videos we have started from the very basics, right? In the first video we laid out the structure for this course. In the second video we discussed the basics, what are the key terms that we need to understand, and then subsequently we have discussed how at a global level climate change is creating impact and then on our country. And then in subsequent videos we have laid out a framework that we use to analyze the economic impact, and then we have seen how climate change is going to impact the agricultural sector, the construction and manufacturing sector. And then in this video, we're going to talk about the service sector. Side by side, in all these discussions on how the various sectors are going to be impacted by climate change, we have also discussed the point that is mentioned as number 6 here, that what are the major policy steps being taken to adapt or mitigate the impact of climate change. So let us get started with the review of this framework, right? We said we are using a 3-part framework. So first step is to understand the importance of the sector to the economy, why we should be worried about any impact to the sector, right? So if the sector is very important to the economy, obviously if it is impacted in a negative way, the overall economy will suffer. Then we see how climate change will impact that sector, the key ways in which it will impact. And the third part of the framework is in what ways different policies are being created to help the sector with mitigation and adaptation. Right now, we have basically discussed agriculture, we have discussed construction and manufacturing, and now we come to the last one, services, we are going to talk about in this video. So with our the preliminaries out of the way, let us now get started with discussing why the service sector is important to the economy. Right, the service sector is one of the most important sectors for the Indian economy. It contributed more than half of the total gross value added to the economy in financial year 2022, which means the year 2021-22. Right, so more than half of the GDP of the country, or GDP measured by the GVA method, came from the service sector, right? And the service sector is very important from an export potential also, right? So among the top 10 service exporting countries, India is among the top 10 countries that export services to the rest of the world. And 254.5 billion worth of revenue was generated from the service sector in FY22, and this has increased quite a lot over the export revenue from FY21. FY21 was in any case abnormal year. Most of global trade was impacted due to the pandemic related lockdowns and all, but even in isolation, this is a pretty important or pretty healthy figure that the sector is earning as foreign exchange for the country, right? And in this, the most important sector is the software and business services, which basically comprises more than 60% of our total service export. So largely software, and then business services such as consulting services, helping other businesses to manage their back offices and all that. So that kind of work India is known as the back office of the world, right? So more than 60% of this total export revenue came from these two subsectors within the service industry, right? And now the service industry is a very large industry, right? So we can't look at every specific service and try and understand its impact. So what we'll do is we'll look at few key services. So what we'll look at in this discussion is the trade, transport, tourism, hotel and restaurant. So we'll just call them the transport and then trade, tourism, etc. And then the financial services, so services such as banking, insurance, etc. And then IT and business process management, the software industry, which is colloquially referred to that, right? So this is basically why the sector is very important to our economy, right? To just repeat, more than half of the GDP measured by the GVA method comes from this sector, and it is also an important source of foreign exchange through export income for the country. So before we now start looking at the impact on various sectors, one very important point that I wanted to discuss was this entire need for decarbonizing the transport sector. Now, transport is a very important part of the economy, right? Without the transportation sector, you can't really create any infrastructure, or you can't like grow your manufacturing industry, or you can't do anything, right? Because just think about it. If you want to build a road, you have to bring the raw material, you have to bring the machine, you have to bring the people. For that, you need transport facilities. Similarly, you have to transport energy, fuel through pipelines, maybe, or through roads or rail network, right? You have to transport electricity through transmission lines and etc. So you need a very strong and robust transportation sector in order to ensure economic growth, right? So that is the necessity of the transportation sector. Now, what we need is to develop a sustainable and low carbon transportation sector. And this is now more about the vehicular transportation, right? How we use various kinds of vehicle to move people, material, machinery, etc. Right. So for now, for our economy to develop in a low carbon manner, or basically to grow in a sustainable manner in which our economic growth does not come at the cost of environment, we need to decarbonize our transportation sector, meaning that we need to reduce the emissions from the transportation sector quite a lot, right? So right now what happens is that the transport sector, it accounts for almost 20% of the total energy use of the country, and almost 50% of the fuel that is used in the country, it goes to the transport sector. And then around 11% of the emissions of carbon dioxide from the entire energy sector, they come from the transport sector, right? So it is a huge emitter of carbon dioxide. And if you look at this chart, it basically shows you by which mode of transportation how much emission is being created. So the green bars are basically the freight in which you transport material and machinery, etc. And the gray ones are passenger transport, right? So you can see trucks are the largest emitter of carbon dioxide for India within the transportation sector, right? And you can see there are some other contributors such as freight, rail, and shipping domestically, right? So these are the green bars, basically the freight transport. And if you look at the passenger transport, so you see two-wheelers contribute the largest emissions, then four-wheelers, and then three-wheelers. And then there are other modes such as bus, domestic air travel, etc. Right? So now what is happening? This is the current picture. And we see that almost 11% of total energy sector emissions are anyway coming from the transport sector. Now, what is happening? The projection is that as India grows more prosperous, there will be greater demand for transportation, right? So projections are that four-wheeler demand will increase, two-wheeler demand will increase, right? So basically, if we continue on the same pathway, if we continue using fossil fuels, then the transport sector emissions are feared to grow substantially, right? And they are currently growing at a rate that is faster than the growth in emissions from other sectors. So if we want to grow in a sustainable manner, again, we need to decarbonize or reduce or bring the emissions from this sector under control. And we will see later in the discussion how various policies are being designed to basically encourage people to move away from fossil fuel based, right, transport to basically things like EVs and hybrids. And the other thing to see is that these are all, at least these two, right? These are private, excuse me, modes of transport, right? And then you see emissions from public modes, buses, passenger rails are much lower in comparison. So again, the other obvious policy step could be to promote the role of public transport in the country, right? So, so that basically is the discussion on how the transport sector is critical to the goal of achieving a low carbon growth pathway for the country. Now let us start looking at the sector-wise impact of climate change on the various important service sectors, right? So let us start with hospitality and tourism. Hospitality and tourism basically means the entire industry around the tourist spots, guides, hotels, restaurants, right? So all of that is covered in these two sectors. So now globally, this industry contributes to around 5% of greenhouse gas emissions. And in our country, it is, we don't have data for our country, but you can assume it will be somewhere similar levels, right? Or maybe a little less because we don't have as developed an aviation sector and all, right? So if you look at the importance of the sector, then it had created around 34.8 or almost 3.5 crore jobs in FY20. So why I've taken a little older data, because this is the pre-pandemic period. So during the pandemic, this sector was impacted very badly because it is a contact intensive industry. You need to be with people in order to like serve them, right? Or in order to provide them tourist facilities. People were not traveling, everyone was locked in their houses. So obviously the employment in this sector fell drastically, right? And now it is recovering slowly. But if you want to look at what a normal year was like, then this year was sort of a good proxy or indicator, right? So 3.5 crore jobs were generated in the country only directly, means these people were employed in the hospitality and tourism industries, right? Now, what will happen because of climate change is that this industry is expected to face a lot of challenges, right? Let us quickly review what will happen. So first of all, we will see that the government will implement more stringent measures for management of waste, and then more stringent measures for efficiency of energy use, right? So for example, how much water of an establishment can use up, how they handle their plastic waste, how they handle their other waste, what kind of energy efficiency ratings the buildings need to have. We have already discussed some codes in the previous discussion on construction and manufacturing, right? So these kinds of rules will become more and more stringent. Now what will happen is that obviously if you need to comply to these, you will have to implement different operational measures which will entail costs, right? So there will be costs of compliance, which if your costs increase, right, then your profit will reduce. So the profits could reduce at least in the near term. And overall, maybe if we are able to move to a sustainable tourism paradigm, then the industry might get to a situation of higher profitability as well. So first impact will be that profits might come under strain. The second is that the supply chain of these industries will be disrupted. Now, what is the supply chain in the hospitality and tourism? Various kinds of food items, right? So obviously we have seen agriculture will be badly impacted. So various kind of food items that they use might like not be available in the quantities they desire, or their prices will increase. So again, their profits will be impacted unless they are able to pass on the increase in cost to their customers, right? Similarly, operations will be disrupted. We see that there will be more floods, more heat waves, more drought situations, more rainfall events. So then operations will be impacted, because if you are in like an area impacted by such extreme climate events, obviously you will not be able to function normally. Then your staff might not be able to come to work all the time, or you might have to provide extra facilities for the staff and all. So basically in these two ways, again your normal operations will be impacted, because you might not be able, because of disruptions in the supply chain, might not be able to provide all the facilities or all the benefits or all the cuisine, for example, to your regular guests, which will impact your profitability or maybe your attractiveness to the guests. And then your operations will be impacted because of the occurrence of the extreme climate events, right? And then staff productivity also, like we have talked multiple times, because the heat levels will increase, then humid heat and wet bulb temperature will impact how productive the staff can be, at least outdoors, right? So that will again impact your operations. The third one is that there are multiple studies basically showing that what will happen as temperatures rise globally is that the flow of tourists to tropical countries, and India is largely a tropical country, right? So the flow of tourists to tropical countries will decrease because the environment becomes very hot. So the level of comfort in moving around during the daytime will go down. So the flow of tourists to tropical countries will decrease, and the flow of tourists to colder countries might increase actually, because there the temperatures then will become more bearable, right, or more comfortable. So what will happen then if, and these international tourists are a major source of income for the hospitality and tourist industry, particularly in the luxury sector and all that. So now if a large part of that traffic goes away, obviously what is happening is your market is shrinking, right? The number of customers who are coming to avail of your services is going down, and therefore then you will lose business, right? You will lose business, which is basically going to reduce your profits, and it will impact your overall industry, right? So this is the other key impact from climate change that this sector is likely to face. And then many of these key tourist attractions, they are going to be directly impacted by climate change events, right? For example, India has many coastal cities which attract large flow of tourists both from within the country and outside, right? Large cities like Mumbai, for example, or Chennai, for example, right? They are coastal cities, right? So they are coastal cities, and large parts of these cities might be submerged if like go on the current path, if we continue on the current path, right? So then tourist attractions in these cities might not be available anymore for tourists to go and see. Similarly, like cities like Delhi and all might become too hot most of the time, or even Agra, like the Taj Mahal, which is like a major attraction globally for tourists, right? So it might become too hot for people to like go and visit the Taj Mahal for most of the year. So all this will then impact the income or the sustainability of this tourist and industry. Similarly, coral reefs in many areas will face large scale bleaching and all. And right, just one more thing is that, you know, if the business is impacted, obviously, like these jobs will also be impacted. So then again, these people will lose their livelihood, and then they might require different kinds of support, which we have already discussed in the video on agriculture, that the government might not be able to provide support. Because if where does the government get money from? From taxes largely, right? So if the business overall declines, the government's income from taxes will reduce, and then it will have less money to spend. It can't continue just borrowing, because ultimately that loan has to be repaid, right? So again, that will also create social challenges when a larger number of people require some sort of support to continue with their livelihood at a very basic level, right? So that is the impact on the hospitality and tourism industry. The second, right, we have already discussed the workforce part. Now, the second industry is the financial services industry. Now, what do we mean by financial services industry? So, like businesses like banks, insurance, mutual fund, etc. Right? So, these kinds of industries basically. Now, why is the financial services industry important? First of all, let us just understand that, and then we will go into the discussion on the impact. The financial services industry mobilizes savings, right? So I'm earning some money, right? I am, let's say, earning 10,000 rupees in a month. Out of that, let's say I'm saving 5,000 rupees. Now I can keep that money in my house as cash, or I can go and deposit in the bank. When I deposit that money in the bank then does not keep that money in the bank account. It basically goes and gives that as a loan to somebody, may let's say, who wants to buy a house, or who wants to buy a car, or to some industrialist who wants to set up a business, right? So now if I want to buy a house and I take a loan from the bank, I go and buy a house, right? So my purchase then creates demand for the housing sector. Now the housing sector needs cement, steel, workers, various kind of electric supplies and all that to build the houses, right? So it creates demands for all those industries, and then the workers in those industries get paid. They go and spend. So then basically by mobilizing these savings and then investing in the economy, the financial services industry then basically creates economic activity, right? So if the financial services industry suffers, then the overall economy will suffer, because now if I want to buy a house, banks don't have money, let's say, or banks are not in a situation to give me money, then I can't go and buy a house. Now if I can't buy a house, then there is low demand for housing in the country. So there is low demand for all the cement in steel, etc. industries. Workers in these industries maybe lose their jobs, their demand goes down. And then instead of like promoting demand or activity throughout the economy, the reverse happens, that the activity overall in the economy starts to shrink. And then like the economy then suffers, right? So that's why the financial services industry is very, very important, right? So that is about banks. Insurance industry basically works in a similar way. Insurance industry helps you cover your risk, right? So we buy health insurance, for example. In the event that I have to spend a lot of money and I have a health insurance policy, then the health insurance company will pay to the extent that I'm covered. Similarly, you can buy insurance against various kinds of accidents such as fire damage, flood damage. You can buy insurance for your life, that in the like if unfortunately you die because of some accident prematurely, then your family continues to like enjoy the same standard of living if you have got adequate insurance coverage. So insurance industry basically allows you to transfer the risk for some premium, right? You pay a premium every year and you get an insurance policy. So then that also encourages activity, because ultimately what happens, this insurance industry also generates these premiums, and this also goes and invests. So all the money that they get, they invest, they don't keep their money. And similarly, the mutual fund industry also in a similar way mobilizes the savings from the household sector basically. people who are working and earning an income, right? So this is the importance of the financial services industry. Now let us see what are the key risks that this sector faces. Now this sector basically faces two types of risks. First is called the physical risk. So the physical risk basically is that these are the direct costs or direct losses that the sector might face from the real world impact of climate change. For example, if the bank has financed construction of a warehouse, right? Now, because of, let's say, landslide, because of very high rainfall, landslide occurs in that area and the warehouse is washed away or is destroyed. Now the bank has given a loan to the company that basically built and was operating this warehouse. Now because of the climate related event, the warehouse is gone and the company was earning revenues from the operations of that warehouse. Now that warehouse is destroyed, the company does not have revenues to pay back the loan. So it declares that I am not able to pay the loan. So the bank basically takes a loss. Whatever loan was remaining, bank has to write it off. That is one type of example. Right. The other example is, for example, some insurance company has insured the warehouse, right? And basically the premium of the insurance company is decided on the likelihood of some damage happening, right? So now historically landslides maybe in that area are not as common. Now suddenly this large scale landslide occurs and now the insurance company may have insured 10 warehouses in that area. Now all 10 are destroyed. Now the insurance company has to pay out the insurance. So again, it takes losses, right? So these kind of physical risks from the real world impact, that how climate change related events are happening on the ground, and because of which the financial sector is taking losses, right? So that is the first kind of risk. The second is the transition risk. So now as we move to a low carbon economy, then there might be various rules and regulations that come into play, right? We discussed in the context of the hospitality industry also, government might impose stringent energy efficiency rules, for example. And we've already seen, right, for example, in the transport sector, the various Bharat stage norms that the government has come out with have gotten more and more intense or more and more strict in terms of what level of emissions are required. And the automotive industry has had to invest a lot of money to make sure that the vehicles comply with these norms. So similarly now, if the government continues tightening various kinds of norms, then what will happen is that these banks or insurance companies, maybe they have invested or given loan to a company, and that loan has come on the basis of some sort of assessment of their credit worthiness, right? For example, to a, let's say, a coal mining company, the bank has given a loan, right? So bank has basically assessed, okay, you have this mine, it will operate for, let's say, 20 years. And every year, let's say you are able to generate 10 crore revenue from this mine. And to repay my loan in 20 years, you need to give me 1 crore rupees, right? So this is the calculation. And because 20-year operation you have and 10 crore, so you will be easily able to repay this loan. On that basis, the bank has given the loan to the coal mine company. Now, if government decides that coal is a highly polluting fuel and the economy cannot bear the cost of continuing to operate on coal, therefore we are going to impose heavy taxation, carbon taxes on coal to discourage the utilization of or use of coal in the economy, right? So now what will happen is that and also we are basically going to move to a no coal economy, let's say in 10-year period. So now what are the assumptions that the bank has made? That in 20 years the loan has to be repaid, right? So now suddenly 20 years mine only will not be operational, right? And this revenue of 10 crore might actually go down because the government is imposing heavy taxes. So the demand for coal will fall in the economy. So maybe from 10 crore, this revenue, let's say, goes to 5 crore. Right. Now in this, now out of 5 crore, this has to pay 1 crore every year, but it was for 20 year period. Now in 10 years, government is saying coal will not be allowed only. So now you have to make sure that your loan is paid back in 10 years, right? And is the company able to pay 1 crore out of 5 crore revenue? So suddenly your calculations or the assumptions that you had made become incorrect, right? And the risk basically then on your loan becoming a loss increases. So in this way, compliance costs increase. Similarly, operating costs for the industry also will increase because energy efficiency related costs, building codes, etc. will increase, right? And the other thing is that when you invest, banks and insurance companies also invest. They buy the shares of various kinds of companies. So again, they have invested, let's say, in a transport company which runs diesel operated buses. Or they have invested in a fossil fuel company, let's say a crude oil mining company. The same issue will come, that because of changing market conditions, what will happen is that these companies might not exist only in the long run, and then their investment or the investments that the financial sector has made in these companies are under threat, right? So these are the basic two ways in which the financial sector is at risk from climate change: the physical risks and the transitional risks. Now, one second, let me just clean this up. The related point about the other kind of risk, or this is more important for the insurance sector, is that financial institutions currently lack the expertise to model the impact of these climate events very accurately. And not just the financial sector, overall we don't have the expertise, right? Because these are all changes that are highly related or interconnected. High intensity of rainfall causes landslide, and then landslide causes property damage. Now we are not able to predict how high the rainfall will be in a coming year, and then how much of rainfall, if it happens, will cause landslide, right? So if we don't know how these interrelations work, we cannot predict the likelihood of, let's say, an event like landslide happening, right? And the insurance industry is all about probabilities, right? All about probabilities. What does that mean? So if I go and buy health insurance, let's say, right? So if I go and tell the health insurance company that this is my age and I don't have any pre-existing disease, then I want to buy insurance for 10 lakh rupees. How much premium will you charge me for 1 year? So insurance company has a lot of data about males in my city, in my age group, and if they have any conditions like any pre-existing condition, like are they obese, are they diabetic, right? Are they smokers, are they alcoholics? So on all that basis, they have created a table called an actuarial table that basically gives them the probability of me being hospitalized in the next year, right? So if the probability is high, then they will charge a very high premium because they don't want to take losses. And if the probability is low, they will charge a less premium. And then they will insure not just me, they will insure 100 others like me, right? So out of those 100 people, if two people need insurance, then insurance company will pay them the insurance amount, but it will make a profit out of the premium of the other 98 people. So that is about the probability. Now, what is key, that the insurance industry is able to develop some sort of assessment of what is the chance of me being hospitalized, and on that basis they will collect premium for me. Now if I am not able to define this probability only properly, then how am I going to cover the risk adequately, right? So in the landslide example, right, we don't have data on how rainfall will lead to landslide. So then the insurance agency will sort of have a rough idea, right, of how likely the landslide is going to happen. So if that premium, if they go ahead and insure the warehouse on that basis, then maybe either they charge very low premium or they charge very high premium. If the premium is very high, then the warehouse company might decide not to insure the warehouse. If the premium is very low, then the insurance industry might face losses, right? So therefore, this is a risk, right? All risks arise from uncertainty, right? So if you are not able to define your risk properly, then as an insurance company, you are going to face losses either through loss of business or through having to pay out large amounts in premium or coverage, right? So this is the second risk. So, and there is a lot of understanding of these risks in the financial services industry. So the consulting firm EY recently conducted an international survey of these chief risk officers across a number of banks globally, and 91% of these CROs said that climate change related risks are the most important type of risks facing the financial services industry currently, right? And then so these are the risks. Now other risks we have already discussed, basically impact on assets. So if you have buildings, you have other infrastructure like data centers and all, so how they are going to impacted by physical events like a cyclone or a heavy rain period or a flood and all that. Business continuity means in the event of any like large catastrophic event, are you able to continue your business normally? And if you are not, then what kind of losses that would lead to, right? Reputation risk, if you are financing, let's say, a coal miner, right? If you are financing a coal miner, then maybe uh, environment focused investors don't want to do business with you, right? So how you handle those kind of things, and these sort of risks are shared across many different sectors, right? So these are common risks that across the business or the economy sectors share from climate change. So this is a summary of the risks that the financial services industry faces. And I was talking about insurance. So this is data from this. There was a report from this large Swiss reinsurance company called Swiss Re. So reinsurance company is basically, so how insurance works is, if this is me, so if this is an individual for I, he goes to the insurance company, let's say called C, and buys a policy. Now this insurance company goes and buys policy from a reinsurance company. So this reinsurance company basically gives insurance to the insurance company, right? So this is the one of the larger reinsurance companies called Swiss Re, right? So they have come out with a report on the impact of climate change, and basically look at the chart on the basically these orange or reddish type of bars. So there are two types of losses that this shows. Uninsured losses are the blue ones, that the property owner did not have any insurance, so they are uninsured, they had to bear the cost. But the insured losses, where the owner of the property had covered their property against insurance, right? So global losses resulting from weather related natural catastrophe, right? So this is from 1980 to 2019. So in the 1980 to 89 period, 74 billion dollar was the insured loss. Means insurance companies had to pay 74 billion dollars to the policyholders. In 1990 to 99, this almost three times it increased to 236 billion dollars. Then in 2000 to 2009, again it increased by 100 and almost 160 billion dollars. And then in 2010 to 2019, again almost 200 billion dollars it increased. So the trajectory is up. The insured losses are increasing. So basically the risk that I was talking about, that as climate events become more intense and more frequent, the losses or the risks to the insurance industry will also increase in a similar way. So this basically gives you the data to back up the claim, right? So now let us look at the other industry, the IT and business process management industry, right? So this industry employs around 5 million people in our country, and like we discussed, is a major source of our revenues from service exports, right? Now, what are the risks that this industry faces? So the first risk is the risk to business continuity, right? So if your offices are impacted, if transport services are impacted, if the major data centers, for example, that you're running, they're impacted by a flood, or their power supply is cut, or some landslide occurs and the data center is destroyed, office is destroyed. So how will you continue running your operations is a major risk. If your people can't come to work, right? If their productivity decreases, or if in order to maintain the same climate or same temperature and conditions within your workspaces, you have to spend more on energy, so your energy costs can increase. Are you able to comply with the energy efficiency norms of the government and all? So all of these things will come into play, right? And then there are risks to information and process security. So what does that mean? So what our experience has been, that whenever there is a disaster, right, whenever there is disaster, people are in a state of panic, and unfortunately a part of our human society is prone to take advantage of this state of panic by running various kinds of scams or efforts to infiltrate and dupe people, right, to make money out of people's misery. So they will give a call that this we keep getting, right, your bank account will be frozen, your telephone will be disconnected, and then call this number, and people fall for these things, right? So if in a situation of societal panic, if some large scale climate event happens and a large section of your workforce is impacted, right, bad actors will try to take advantage of this situation. And now the IT and business process management industry, the workers in this industry have a lot of critical information of various companies at their hands, right? So if you are handling, let's say, uh, customer relations for a large telecom company, right? So today the telecom company themselves do not handle, right? So if a large telecom company has outsourced their customer relations to your company, you are a business process management company, right? Now your employees have access to all the data of the telecom company's customers. Now if in some way some scammer is able to get that data out of your employees or get access to those systems, and then through that hack the bank account, let's say, of that customer and cause them financial loss, right? So then you will lose the business of that telecom service company, right? They will say, no, you are not able to maintain proper information security, so we cannot trust you. And you will also make losses for the client, right? So if a bank is in a similar way, your client, and your because of whatever disaster situation and panic and all, some hacker is able to gain access to the bank's networks, then again the bank will lose business and you will lose business. So this is also a real risk to the IT and business process management industry. Right, and then the loss of asset, again the same thing, various buildings, various IT related infrastructure, or data, right? And impairment of their value. Impairment means basically lowering the value, right? So if some large campus you own and let's say a large part of that campus is hit by a landslide, then your value of that campus then goes down, and that then impacts the value of your company, right? Or if your like shares are being traded, then your shares will go down in price and your investors will be impacted. So this is a summary of the key ways in which the IT and business process management industry faces various kinds of risks from the phenomenon of climate. So we've looked at the various kinds of risks. Now let us start looking at the various policy initiatives that are being implemented to help these sectors address the impact of climate change. We'll start with the transport sector, where we'll look at a few key schemes that the government is implementing, and then we'll move to the other sectors, right? So the first one is the FAME to India scheme. FAME stands for Faster Adoption and Manufacturing of Hybrid and Electric Vehicles scheme, right? This was launched in 2019 as a part of the National Electric Mobility Mission Plan, which basically is aimed at helping the country secure fuel security, right? We have discussed that we are net energy importers, right? Around 85% of our fuel needs are met through imported fuel, right? So through fuel security, basically the aim is to reduce this dependence and be more dependent on indigenous sources of energy. And the electric mobility mission plan basically aims to promote hybrid and electric vehicles. Hybrid vehicles are basically that run both on fossil fuels as well as electric power, and electric vehicles obviously are battery operated, right? So FAME 2 will run till March 2024, and under it basically the government is giving subsidies to various kinds of electric vehicles and also promoting the creation of charging infrastructure. So these vehicles are battery operated, so how you charge these also is going to determine how successful they are in like replacing fossil fuels. So if charging infrastructure comes up at a large scale in the country, then people will buy it, because then you don't have the fear that, oh, my battery runs out, then what will I do, right? It should not be that you are able to charge only at your home. So if just like petrol pumps, there are various charging points, you can just go and pay a fee and charge your vehicle, then that will increase the adoption of electric vehicles, right? So basically subsidies are offered for buses, three-wheelers and two-wheelers and cars. Right, so buses, three-wheelers, two-wheelers and cars, and mostly for vehicles other than two-wheelers, the subsidies are for vehicles that are used in commercial transport or passenger transport, right? Because you don't want to basically, then we discussed that promoting public transport is also a way in which our emissions from the transport sector can be reduced, right? So the government wants to basically encourage adoption of these what you call electric and hybrid vehicles in these sectors, where then each rupee that the government basically spends is going to be more efficient in reducing emissions. Because think about it, right? All these buses, three-wheelers, etc., will be used much more if they are used for public transport or for like commercial transport, right? Private cars and all are largely most of the time not being used, right? So the idea is that why don't you give support to vehicles that will be used more, so you are basically helping reduce emissions, right? In a large extent, because if you replace a bus with an electric bus, then that bus is maybe running for 16 hours in a day, right? So that emission you have taken off. But if you replace a car, then that car maybe is running only for 2 hours a day. So for the same amount of support, you can get much more output in terms of emission reduction. So that is the idea. So that was FAME. Now the second one is the auto and auto component PLI scheme. PLI scheme we have already discussed that through this basically the government is trying to encourage manufacturing industry in the country in certain key sectors, and more than 2 lakh crore rupees it has earmarked for spending, right? So this auto and auto component scheme was launched in September 2021, and the government has planned to spend more than 25,000 crore, almost 26,000 crore rupees during this 5-year period in this scheme, right? And one of the key components in which the government will incentivize the creation of manufacturing capacity is the manufacturing of electric vehicles, battery operated, and also vehicles that are operated by hydrogen fuel cells. So hydrogen, we have discussed, can be used as a fuel. Burning the hydrogen creates water vapor and creates a lot of energy. But right now we need the development in technology to be able to adopt this as a fuel. So gradually how we support the adoption. So that kind of work also the government will support through the PLI scheme. The next PLI is the advanced chemistry cell battery storage, right? So we need like if we are going to replace fossil fuel based or ICE, what is called internal combustion engine based vehicles by EV or electric vehicles, then we need battery technology also, right? How, and if we are able to develop advanced batteries that are able to store energy for long and in a small space large amounts of energy can be stored, then these vehicles will gain more acceptance and more adoption, right? So if you are able to, let's say, give a scooter a range of a few hundred kilometers through small batteries, then maybe everyone will want to buy those scooters, right? It will be more attractive rather than a scooter which you need to recharge every 100 kilometers or so, let's say, right? So these advanced chemistry cell batteries basically are advanced types of batteries which are able to store energy either as electric energy or as chemical energy, and then that is converted into electric energy on demand, right? Globally there is a lot of R&D and develop manufacturing capacity creation going on in this sector, and India also wants to ensure that adequate manufacturing capacity and R&D happens in our country on this technology, right? So this PLI was launched in January 2022, under which 18,100 crore rupees of outlay has been earmarked. Government will give subsidies of this much amount to companies that set up capacity to manufacture ACC batteries. So the aim is to support the creation of 50 gigawatt hours of capacity of manufacturing capacity in the country through this scheme, right? And this is a huge amount, right? So a car basically has a battery anywhere from 35 kilowatt hour to the very large and very powerful cars have around 70-75 kilowatt hours, right? So from this, even the very large cars, almost 7 lakh large cars can be supported from this capacity that the government aims to create through this ACC PLI scheme, right? So these are the key schemes for the auto sector or the transport sector. The other one is not yet implemented. So the Niti Aayog has published a draft battery swapping policy in April 2022. Now, what is battery swapping? So now think about how currently we use our vehicle. So if we have a car, it runs out of petrol, we go to a petrol pump and fill the petrol, and it takes like, let's say, 5 minutes and we are done. But what happens if we have an electric vehicle? If it runs out of charge, we have to plug a charge point, and then maybe it takes an hour or maybe it takes more than that to get it charged, right? So that means that either you have to charge it at home, or if you run out of charge, you have to find a charging point and then spend significant time charging your vehicle, right? And that charging point takes, let's say 1 hour to charge one vehicle. So then either that is able to service a very small number of vehicles in a day, right? There are only 24 hours in a day, or you need a lot of space to create like a lot of charging points, then you can service a large number of vehicles. So then that limits the scale to which you can implement this charging infrastructure. What battery swapping does is similar to what the petrol example is. When you run out of charge on your vehicle, then you go to a battery swapping station, they pull out the discharged battery and they put in the charged battery, and then you're on their way. You pay the whatever fee they need, and you're on your way. It helps in two ways. First one we have already discussed. In that way you can service a lot more vehicles, right? You will need less space right? You will not need to create 100 charging stations. You just need to create space to store those charged batteries and the discharged batteries safely, right? And that is it. The second is that it reduces the cost of these electric vehicles also, right? Because then you don't have to buy the vehicle with the battery, right? You can buy the vehicle and then you can rent the battery, right? You take the battery on rent, and every time it is discharged, you pay a fee and you replace the discharged battery with a charged battery. So in that way also it increases the adoption of the electric vehicles, right? So it reduces the cost of both buying the vehicle and also operating the vehicle, right? And you then, because you need less space, you can set up charging infrastructure at more points in cities where land is more expensive, right? And also difficult to get, right? And obviously it will reduce the time. So then people will be more interested in buying EVs even for longer distances, right? Because then if you run, you just at 5-minute job, you pull out your battery and replace with a charged battery, and then you are on your way, right? The other thing is that it will lead to creation of a new industry called battery as a service. Battery as a service. So basically companies will come up that will just be in this business, right? Like today there are companies that run petrol pumps. There'll be companies that run these battery swapping stations, right? So they will charge their batteries and they will store them. You have a specific kind of car, you go to that, you tell them ki this battery is needed, they will pull out your battery, they will replace, and then you're on your way, right? So the key things here are to make sure that rigorous standards are there, right? Because these are fairly large batteries, so we have to have proper safety standards. We have to make sure that the batteries are then across different kinds of scooters. Let's say right now there is no petrol for a Hero Honda bike and a different kind of petrol for a Bajaj bike. A petrol works across different kinds of vehicles, right? So similarly we will have to create battery standards, so that similar to what pencil cells are there, right? That a pencil cell of a double A size fits in any slot of double A size appliance, right? So similarly for a scooter made by, let's say, Ather, or a scooter made by Hero Honda, or Hero Honda is no more there, Hero, right? Hero Electric, let's say. So they should be able to operate on the same battery. Only then this industry will grow, right? So those kind of standards will have to be developed, and industry-wide acceptance will have to be there. Therefore, this policy is right now in a draft stage. Consultations are going on before this is finalized. But this is an important step in, again, promoting the wider acceptance of electric vehicles in the country. So that covers the basic discussion or review of the policies for the transport sector. Now let us come to the financial sector. So one important overarching theme that we'll see in this discussion now is how green finance is being promoted through various initiatives. So first of all, let us understand what is green finance, right? So broadly, green finance means that you are financing investments in infrastructure or various kind of projects that are sustainable environmentally, right? So they are basically having environmental benefits. So things like promotion of clean energy, or creating infrastructure in a way that they don't it doesn't have harmful environmental impact. For example, roads that are built of recycled material and use less concrete, etc., right? Or power projects of wind based power projects or solar power projects and so on, right? So the finance that goes into supporting the development of these kinds of projects is generally called green finance, right? And basically through what are called bonds, a lot of green finance is being mobilized. A bond is basically a loan, right? If the government sells a bond, basically it is, and you buy that bond, basically you are giving a loan to the government, right? And they have fixed interest rates and they have fixed maturity. For example, it may say 10% coupon, 10-year maturity. It means that you will get 10% interest annually, and your principal will be paid back to you by after the end of 10 years. And these bonds are also traded. So if you don't want to hold on to the bond for 10 years, before that you can sell it to anybody else, and then you get your money, and the buyer then can sell or can hold or whatever they want, right? And when you sell the bond, then you will not get the interest anymore. Obviously, the person who holds that bond will get the interest, right? So that is the idea of bond. Now there are a new category of bonds called green bonds and sustainable social bonds, sustainable bonds, that are gaining in prominence. So let us look. So this is data from an international agency called the Climate Bonds Initiative. Basically, this is a compilation of various kind of special purpose bonds, right? So the green bond is the most important category, where the money is raised to support environmentally beneficial projects, right? So there is internationally a classification of what kind of projects can be supported through these green bonds. Similarly, there are different kinds of bond called social bond, where investors go and invest in projects that have social benefits like education, infrastructure creation, health infrastructure creation. Similarly, sustainability related projects, right? And then basically different kinds of energy transition and other specific use purposes are supported through these kinds of bonds. Now, this in 2021, these specific categories of bonds have helped raise more than $1 trillion globally, right? More than $1 trillion globally. And in that, green bonds are the largest category. Now, in our country also, the uptake of green bonds is increasing quite a bit, right? So basically, in 2022, estimate is that more than $450 billion were mobilized through green bonds, right? So if you look at this, this is total across these different bond categories. This was 1 trillion in 2021, right? Now if you talk only of green bonds, then more than 450 billion was raised in 2022 globally, right? And estimates are that in 2023 this could cross 1 trillion, so more than double. So among developing markets or emerging economies, India is in the second spot in terms of raising money through green bonds after China, right? So this is India, right, for 2020, right? The dark blue part is the corporate money raised, and light blue is the sovereign and government. So in 2020, there was no sovereign green bond issue from India. So these are various other government agencies that have issued green bonds to raise capital for financing of environmentally beneficial projects, right? So now we are talking about sovereign green bonds, basically green bonds that are issued by the government, right? So in November 2022, government released a green bond framework, basically specifying what are the kinds of projects that the money that is raised from these green bonds will be used for, right? And then in early part of 2023, January and February of 2023, RBI conducted two green bond auctions where it sold the green bonds, and 16,000 crore rupees were raised. And this was the first time India has raised money through sovereign green bonds. And depending on how well this and this went well, right? And now maybe in the future we will see more green bond issuance coming from India in the form of sovereign green bonds. And this we have already discussed, that they will basically finance or refinance, that they will pay back some of the loans and from the money that they have raised through these green bonds for various green projects. So that was about the green bond. Now, various initiatives of the RBI or the Reserve Bank of India as the regulator of the banking system in India to promote sustainable finance, or finance that basically goes and promotes investment in sustainable development. So back in 2007, RBI had, in its role as a regulator, given an advice to the various banks that you should start thinking of how you will use your activities, commercial activities, to promote sustainable development. So in what ways you can give loans to various kinds of projects and initiatives that support climate friendly growth, right, or environment friendly growth, right? The major another major step is that it has included renewable energy projects under what are called priority sector lending norms. And we will come to priority sector lending norms in a minute, but this also includes the solar rooftop projects. So renewable energy projects being implemented by large companies are included, as well as if I want to put up a solar rooftop plant in my house and I take a loan from the bank for that, that is also included in the priority sector lending norms. Now, what are these priority sector lending norms? We won't go into the details, but at a very high level, depending on which kind of banks it is, generally for commercial banks, 40% of their loans have to be given to sectors that are basically included by RBI in this priority sector. The idea is that in these key sectors, there should be adequate supply of credit, right? So depending on which kind of bank it is, it can go up to 75% of total loans also. But under the priority sector, so banks have to give loans to these sectors, so that 40% of all loans that they have given in a year, 40% have to go to these sectors, right? And then RBI has established a sustainable finance group, right? There's a typo, right? So RBI has established a sustainable finance group to lead efforts in the area of sustainable finance and climate risk. So this basically is building expertise within the RBI as a regulator. What actions should I take? What are the best practices being followed internationally? How I should prepare the country's banking system for the future. So all these things, this sustainable finance group will basically develop expertise within the RBI as a regulator to make sure that the financial sector of the country is prepared for the various kinds of impacts of climate change. Then internationally also RBI is participating in a few initiatives to build capacity and also to contribute to international efforts, right? So the first one is the Sustainable Finance Study Group, right? So this was first created in 2016 and now in 2021, the G20, which is the group of the world's 20 largest economies, has re-established this SFSG, right? And the basic task of this is to develop a G20 roadmap for sustainable finance, right? How G20 countries should structure their financial systems to incentivize and grow sustainable finance. Basically, finance which is able to support the development of environment friendly projects and also basically move the economies to a lower carbon pathway, right? And also understand what are the barriers, right? Why, if there is like lack of success in raising climate friendly finance for climate friendly projects, so why is that so? What kind of barriers we are facing and in what way we can take steps to reduce these barriers or remove these barriers. The second one is the Financial Stability Board or the FSB. Now this was again established by the G20 in April 2009. It succeeds a body called the Financial Stability Forum. So the Financial Stability Forum was a group of the world's major financial sector regulators, right? Major financial authorities from multiple countries, they had formed this group. And now this Financial Stability Board largely is a larger organization, right? So this basically includes authorities from all the major economies in G20, the Financial Sustainability Forum members, and also members from the European Commission. And the task of this again is to study in what ways sustainable finance can be encouraged, right? The next one, again in international initiative, a long name, Central Banks and Supervisors Network for Greening of the Financial System. So this is a group of central banks like Reserve Bank and various kinds of monetary supervisors in different economies across the world. So here they share the best practices. These are the ways in which we are promoting sustainable finance in our country. Maybe you can learn from this. Maybe you can adapt these things to your country and develop environment and climate risk management, right? We saw that right now our understanding of risk is in many ways limited. So how we can improve that so that we have a better handle of various kinds of probabilities. We know what is the chance and then how we should model and what kind of cost we should assign to this risk so that we like have a better idea of what kind of impact it might have on our financial sector, right? So that work is being done in this group, right? So RBI joined this group in April 2021. And the final one is again a long name, the Basel Committee on Banking Supervision's Task Force on Climate Related Financial Risks. So here the focus is on understanding the financial impact of climate change and how we should measure this financial impact, right? And again, the Basel norms basically are around how banks are governed, what kind of capital they should have to make sure that they are not at risk and all. So that structure, the bank governance structure, will also be updated to make it strong or resilient against the likely climate risks that we are going to face. So the financial sector basically becomes resilient. So RBI will both contribute to this process of development of knowledge and also learn from other members as to what they are doing in their respective economies, and then they will implement it in the Indian economy, right? So that concludes our discussion. We saw what are the various kinds of impacts that the major service sectors are going to have, and we discussed some key initiatives that are being implemented both in the country and also as part of larger global initiatives. And now to conclude, we'll just do a quick recap of what we discussed. So first we saw that the service sector is very important to the economy. It contributes more than the half of the GDP or through the GVA method, and a large earner of foreign exchange, and also provides large scale employment, right? And we also discussed that if we have to successfully move to a low carbon pathway, the decarbonization of the transport sector is a key priority. And right now, emissions from the transport sector are growing at a very rapid rate, much faster than emissions from other sectors of the economy, right? Then we saw how the hospitality and financial sectors have multiple types of climate risks that they are facing, and how major policies are being crafted both in the country and as part of larger initiatives globally to help these sectors adapt or mitigate the impact of climate change, and also to develop regulatory capacity to develop policies in order to make us prepared to address climate change in a more structured and uh, robust manner, right? We will close this course in the next video where we will just take an overview of the economy level impact, how GDP will be impacted, and also some assessments of how prepared India is as an economy to address the impact of climate change. Again, if you have not seen the earlier video, I would urge you to go back to the other videos in this playlist and go through those videos. I'm sure you will find a lot of information that is useful for the exam in these videos. I'll see you soon in the next video. Till then, take care and bye.